Hello, my dear students. A very warm welcome to all of you in Shri Jayendra Rank Zone. I am your friend and mentor for this subject, Principles and Practices of Accounting. In this lecture, we'll continue with Chapter 4, that is Inventories, and all the concepts will be covered in the coming series of lectures. This is lecture number 2 for Inventories. Let us learn today how are raw materials and other supplies to be valued as per AS2. Kindly take the notings. How are raw materials and other supplies to be valued? As per accounting standard 2, that is valuation of inventories. Case 1. Case 1. If finished product are expected to be sold at or above the cost, in that case, materials and other supplies should be valued at cost. Then materials and other supplies should be valued at cost even if there is any decline in the price of materials. In the price of materials later on. Case 2. If finished product are expected to be sold below cost, below cost, in that case, what would be the treatment? Materials and other supplies should be valued at cost only, should not be valued at cost, should be valued at NRV, should be valued at net realizable value net realizable value, that is NRV, if there any decline in the price of materials. In the price of materials. In such circumstances, the replacement cost of the materials may be the best available measure of their net realizable value. I believe you understood. Let us try to understand it more well by taking an example. Just try and understand that supposingly the cost of raw material is 5 rupees. The cost of raw material is 5 rupees and other replacement cost is 12 rupees. Just write other replacement cost is 12 rupees. So total value of finished good is 17 rupees. Now there would be three circumstances. First, we are able to sell this product at 17 rupees in the market, or we will get more than 17 rupees in the market. In these two cases, the raw material will be valued at cost, will be valued as cost. But if we are able to sell this finished goods in less than 17 rupees, less than 17 rupees, in that case it would be valued below cost. So just say raw material equal to 4 rupees below this. Have you understood? Let's take one more example. Raw material purchased, raw material purchased 10 rupees. Supposingly the replacement cost is 12 rupees. Raw material replacement cost is 12 rupees. So if replacement cost is more than this, finished goods cost is 20 rupees and finished goods will be able to sold at finished goods will be able to sold at 22 rupees. 22 rupees. In that case, if you can just see, if finished goods is able to sold at 22 rupees, the raw material would be valued at cost, that is 10 rupees. Just try to match the concept from here. The raw material is 5 rupees, other replacement cost is 12, finished good is 17. If finished goods is able to sell more than 17, more than 17, raw material is valued at cost. So over here also raw material will be valued at cost, that is 10 rupees. Take one more example. Case 2. Raw material purchased 10 rupees. Raw material replacement cost Raw material replacement cost is say 12 rupees. The cost of finished goods, whatever finished goods we will produce, its cost is 20, but we are not able to sell finished goods at 20. Finished goods is sold at 18 rupees. Finished goods is sold at 18 rupees. So in this circumstances, finished goods is sold at below the cost. So we need to see the raw material purchase, the cost price or replacement cost, whichever is lower. So in this case also, the lower is rupee 10. So it would be the same answer, lower. Let's see one more example. Raw material purchased, rupee 10. Raw material replacement cost is rupee 8. Finished goods cost rupee 20, and finished goods is sold at 18. So you can see the sale is lower than the cost. This means what? We need to see cost or NRV, whichever is lower. Lower is replacement cost, so it would be valued over here at replacement cost. I believe you understood this. Okay, let us move ahead. Let's learn the new concept, treatment of loss. Treatment of loss in the valuation of inventories. There could be a normal loss, or there could be a abnormal loss. Abnormal loss like theft, which generally don't occur. Normal loss like loss which can be estimated in advance. Normal loss is a loss generally which can be estimated in advance. When we transfer the petrol from one place to another, a bit of petrol, like a particular amount of petrol, generally evaporates because of the heat in transit. But that is a normal loss. We could estimate it in advance as per our experience. But theft we cannot estimate in advance. So let's take an example of normal loss. 100 units at rupee 10,000. 2% normal loss. 2% normal loss. Now my question is how you will be calculating the cost per unit. How you will be calculating the cost per unit? Cost equal to, or cost per unit equal to 1,000. Basically amount is 1,000. 1,000 is for 100 units, right? But there is 2% loss, so 2 unit is gone. The remaining unit is 98 units only. So 1,000 divided by 98. Do it. 1,000 divided by 98. What is the figure you got? This is 10.23. So you will value the inventory at 10.23. You will value the inventory at 10.23. Let us see the example of theft, that is abnormal loss. Supposingly 100 units are there, valued at 10, that is 1,000. 2 units loss was loss by theft. Loss by theft, 2 units, that is 2%. Over here, how we will calculate cost per unit? Cost per unit equals to this price. This is 10. How come? 1000 divided by 100. 1000 divided by 100. We got what? 10. Now what would be the accounting treatment for loss by theft? So basically rupee 20, that is loss by theft, is charged to profit and loss account. Just write over here rupee 20, that is loss by theft, will be charged to profit and loss account, that is income statement. Clear? Let us take an example to understand it well. Example: purchased 100 units at rupee 10. Out of that we sold 60 unit at the rate rupee 15. Net realizable value equal to rupee 14. Cost equal to, basically how we will calculate the cost. So from 160 unit is sold, so 40 units left, multiplied by rupee 10 equal to 400. Let us calculate the net realizable value. NRV is 14, so 40 units multiplied by the realizable value is 14. 40 multiplied by 14 is 560. So the value of closing stock will be 400, because cost on NRV, whichever is lower. Value of closing stock, closing inventory, equals cost or NRV. Cost is 400, NRV is 560, whichever is lower. Whichever is lower. So inventory is valued at rupee 400. I believe you understood till here. Let us continue. The new concept which we are going to discuss is inventory record system. Inventory record system. There are two principal systems of determining the physical quantities and the monetary value of inventories sold and in hand. One system is known as the periodic inventory system and the other system is known as perpetual inventory system. Periodic inventory system and perpetual inventory system. The periodic inventory system is less expensive to use as compared to perpetual method, that is perpetual inventory system, but the useful information obtained from perpetual information system inventory system is more than cost incurred on it. That means the perpetual inventory system is more beneficial, and these systems are distinguished on the basis of their actual records kept to ascertain the cost of goods sold and the closing inventory valuations. Let us begin with the periodic inventory system. Let us begin with the periodic inventory system. So periodic inventory system is a method of ascertaining inventory by taking an actual physical count periodically. So actual physical count is taken as a stock audit or measure of weight of all the inventory items on hand at a particular date on which the inventory is valued. It is because of actual physical count that the system is also called physical inventory system, because the inventory is counted as in a physical manner. But what is the issue over here is, whenever the inventory is counted physically, the inflow and outflow of inventory should be stopped, because if there would be an inflow and outflow of the inventory from the warehouse, at that point of time the physical inventory counting, the physical inventory system will fail, and that is why the work has to be stopped while we are counting the physical inventory. The cost of goods sold is determined as follows. Just see. So opening inventory, it is known to us, plus purchases, it is known to us. Whenever we will purchase, we'll get the bill, minus closing inventory. So basically how closing inventories will be calculated by physical count. Closing inventory will be calculated by physical count, and out of that we'll understand the cost of goods sold. We calculate the figure of cost of goods sold. We have opening value, we have purchases value, but closing value we don't have. We physically count and record the closing value and will reach to cost of goods sold. Periodic inventory system is very simple and less expensive than perpetual inventory system. In this system, inventory account is adjusted at the accounting year end to determine the cost of goods sold. This system suffers from so many limitations. The first limitation is physical inventory taking is required more than once a year for preparation of quarterly or half yearly financial statement. If we want to make a quarterly statement, we need to do physical inventory quarterly. We also need to make half yearly financial statements. In that case, we need to do physical inventory half yearly also, and thereby making this system more expensive. Second, physical count of goods required closure of normal operations of business. Obviously, because if the normal course of normal operations of business won't be stopped, the physical count won't be possible. So whenever the auditor is doing the physical count, at that point of time, the normal operations of the business, the production, should be stopped. Third, as cost of goods sold is taken as residual figure, it is not possible to identify loss of goods due to pilferage, damage, or even fraud. So see what happens. We calculate the closing figure. We calculate the closing figure, closing stock, and whatever closing stock we calculate or we find out in the warehouse while in doing the counting, at that point of time that should be considered as a closing stock. So the stock that is damaged or fraud or any pilferage has happened, we never know. This data is absolute uncalculated. Inventory control is not possible under this system. You just count it. You cannot control pilferage, damage, and fraud systems, because you never know that whether fraud has happened or not. So there is no inventory control system which is possible. Books of accounts does not reflect the inventory in hand and the value thereof. It is difficult to plan operations, how much or when to order manufacture. Okay, let us continue. So this system is used by generally the small businesses, small enterprises, where it is easy to control physical inventory. This system is not considered suitable for medium and large enterprises, which generally use perpetual inventory system. They don't rely more on periodic inventory system. But if you want a good inventory system, if you want a good internal control system in terms of inventory, you should use both the systems and take the advantage of both the systems, that is perpetual inventory system and periodic inventory system. Let us see the perpetual inventory system now. What is perpetual inventory system? Perpetual inventory system is a system of recording inventory balances after each receipt and issue. So whenever we have received the inventory, that means we have purchased the inventory, we should record. Whenever we have issued the inventory, that means we have sold the inventory, we should record. In order to ensure the accuracy of perpetual inventory records, the physical inventory should be checked and compared with recorded balances. Under this system, the cost of goods issued is directly determined and inventory of goods is taken as a residual figure. With the help of inventory ledger, in which flow of goods is recorded on continuous basis. The basic feature of this system is the maintenance of inventory ledger to have records of goods on continuous basis, and under perpetual inventory system the closing inventory is determined as follows. We already know the value of opening inventory, so opening inventory is already known to us. Purchases during the year is also known to us. Cost of goods sold is also known to us, and what we calculate is closing inventory, that is the balancing figure. These three figures are known to us: opening inventory, purchases, and cost of goods sold. Opening inventory plus purchases minus cost of goods sold equal to closing inventory, and that is the balancing figure. Hope you understood it well. Perpetual inventory system helps to overcome the limitations of periodic inventory system. As inventory is taken as residual figure, it includes loss of goods. However, the main limiting factor is the cost of using this system because it is quite costly. Distinction between periodic inventory system and perpetual inventory system. Both the systems, whether it is periodic inventory system or perpetual inventory systems, are not mutually exclusive and complementary in nature. They help each other. Distinction between both the systems can be explained as follows. As I told you that if you are using periodic inventory system and perpetual inventory system together, it would be a better internal control system for inventory valuation in the company or in the business, which could prevail. Let us see the difference between periodic and perpetual inventory system. First, this system is based on physical verification, physical stock count, periodic stock counted physically. Over here, it is based on book records. So we make record whenever issue and receipt is there. Record when receipt and issue. Second, the system, periodic inventory system, the system provides information about inventory and cost of goods sold at a particular date, because at a particular date the stock count has happened. Perpetual inventory system, it provides continuous information about inventory and cost of sales. Third, this system determines inventory and takes cost of goods sold as a residual figure. Over here, we calculate closing inventory. We already know opening inventory, we already know purchases. We calculate or we count the total inventory, closing inventory. Opening inventory plus purchases minus closing inventory is cost of goods sold. So that is a residual figure. Over here, the closing inventory will be the residual figure. So it directly determines the cost of goods sold and computes inventory as a balancing figure. I believe you understood. Let us see point number 4. Cost of goods sold includes loss of goods as goods not in inventory are assumed to be sold. Cost of goods sold includes loss of goods as goods not in inventory are assumed to be sold. So damages, pilferages, theft will not be able we won't be able to find in case of the physical stock count, that is the periodic inventory system. In case of perpetual inventory system, closing inventory includes loss of goods unless goods are assumed to be in inventory. Point number 5. Under this method, we can say that inventory control is not possible. We cannot do any control over the inventory. You just count it. Physical count is possible, control is not possible. But over here in perpetual inventory system, inventory control can be exercised under this system. Point number 7. Periodic inventory system is simple and less expensive, whether perpetual inventory system is costlier method, and this is the biggest limitations of perpetual inventory system. Periodic inventory system. So periodic systems require closure of business for counting the inventory. Regular work should stop. Whenever physical count is taking place. Physical count is taking place. But if we talk about perpetual inventory system, inventory can be determined without affecting operations of the business. The operations of business should not be stopped over here. Normal operations of business, normal operations of business should not be stopped, should not be stopped in case of perpetual inventory system. Okay, let us continue. The next topic is formulae or methods to determine the cost of inventory using historical cost methods. Formulae or methods to determine the cost of inventory using historical cost methods. There is no unique formula for determination of historical cost of inventory. The different techniques for valuation of inventory have been discussed below. The first technique is specific identification method. The first technique of inventory valuation is specific identification method. Let's see this. So pricing under this method is based on the actual physical flow of goods. Actual physical flow of goods. It attributes specific cost to be identified goods and requires keeping different lots purchased separately to identify the lot out of which units in inventories are left. The historical cost of such specific purpose inventories may be determined on the basis of their specific purchase price or production cost. This method is generally used to ascertain the cost of inventories of items that are not ordinarily interchangeable and their value is high like expensive medical equipments. Otherwise, it requires to use FIFO, that is first in first out, or weighted average price or average price formula. Specific identification method. Let's see an example to understand this. Supposingly on 1st May 2013, we purchase 100 units at rupee 40. 1st June 2013, 60 units is purchased at the rate rupee 60. 1st July 2013, 70 units purchased at rupees 65. So this is the stock we have. Out of it, we sold 60 units that we have purchased on 1st of June 2013, as well as we sold 40 units that we have purchased on 1st of July 2013. This means we have sold some units from here, some units from here, and this we haven't sold. How we will calculate the value of closing stock? So the value of closing stock equals 100 unit at 40 rupees, 1st May 2013, 100 units multiplied by rupee 40 plus 60 units is sold over here. So 1st June there is no inventory. From 1st July 70 units, out of that 40 is sold, so 30 is left. The inventory is there. So 30 units inventory is there. 30 units multiplied by rupee 65. So 100 units multiplied by rupee 40, 400 plus, so 100 units multiplied by 40 is 4000 plus 65 multiplied by 30, 65 multiplied by 30, 1950. So the inventory is valued at 5950. This is the value of closing inventory, 5950. I believe you understood it well. Let us continue. We have done with specification identification method, and we are beginning with the FIFO method, that is first in first out. Let us try and understand by the text. This method is based on the assumption that costs should be charged to revenue in order in which they are incurred. That is, it is assumed that the issue of goods is usually from the earliest lot on hand. The inventory of goods on hand therefore consists of the latest consignment, because the previous consignments had been already sold or issued. Thus, the closing inventory is valued at a price paid for such consignments. The FIFO formula assumes that the items of inventory which were purchased or produced first are consumed or sold first. FIFO: first in, first out, first made, first consumed, first issued. Consequently, items remaining in the inventory at the end of the period are recently purchased or produced. This assumption is in line with the good business practices to disposing goods in order to their acquisition, especially in the case of perishable goods and items with frequent technological changes. It must be kept in mind that the assumption of or goods flow cost flow or goods flow need not be true as the physical fact. That is, not necessary goods are physically also sold or issued in the chronological order of their purchase or production. It relates only to the method of accounting and not to the actual physical movement of the goods. Now, let us take an example to understand the applicable FIFO method. A manufacturer has the following records of purchases of raw material which he uses while manufacturing final product. The date is given over here, December 4. The quantity is 900 units and the price per unit is 5 rupees. December 10, the quantity is 400 unit and the price is 5.5 rupees. December 11, the quantity is 300 units and the price is 5.5 rupees. December 19, the quantity is 200 units and the price per unit over here is 6 rupees. December 28, the quantity is 800 units and price per unit is 4.75. Let us see the issues figure. Issues were made as follows. December 5, 600 units were issued. On December 12, 400 units were issued. On December 29, 600 units were issued. In total, 1600 units were issued. I believe you understood. Over here, this is the purchase of raw material, that is 2000 units. Out of that, 1600 units issued. Remaining is 1000. The remaining units will be 1000, but we should understand over here that this 1000 which unit. So 1000 should be calculated from here, that is the latest one. So on December 28 we purchased 800 at 4.75, so 800 will be taken from here, and 200 on December 19, so 200 6 rupees, so 200 multiplied by 6 plus 800 multiplied by 4.75 will be the value of actual closing stock. So 200 multiplied by 6 rupees is 1200. 800 units at the rate 4.75, that is 3800. The value of closing inventory is 5000. I think it is absolutely clear. I think it is absolutely clear. Let us see one more example of FIFO. Supposingly, there is a purchase of 100 units at the rate of 12 rupee. Again, there is a purchase of 100 units at the rate of 13 rupees. Now, issued 200 units at the rate 17 rupees. Then again purchased 150 units at the rate of 12.5. Again issued 100 units at the rate 18 rupees and again purchased 50 units at the rate rupee 13. So we had made purchase of 100 units 12, purchased 100 units at 13 rupees, then we had issued 200 units at 17 rupees, then we have purchased 150 units at 12.5 rupees, then we have issued 100 units at 18 rupees, and then we have purchased 50 units at 13 rupees. What we need to value? We need to value the closing stock. We have to value the closing stock. What would be the value of closing stock? So because this is FIFO method, first in first out method, first we need to calculate what is the closing stock, and then we'll see how can we value it. Just see the purchases 100 plus 100, 200, 200 plus 150, 350, 350 plus 50, 400. So purchases is 400. Purchases is 400 units. From this 400 units, we had issued 200 units from here and we had issued 100 units from here. That means we had already issued 300 units. So we have 100 units in the closing stock. We have 100 units in the closing inventory. I believe it is clear to all of you, 100 units. So over here we have purchased 100 plus 100 units, that is 200 units. Out of that we has already issued 200. So this is already done. Then we have purchased 150 units. Out of that we have issued 100 units. So this we have, from this we have issued 100. That means over here the remaining units is 50. The remaining units over here is 50. And again we have purchased 50 units over here. So 50 plus this purchased 50. So this should be valued and this should be valued. So 50 multiplied by 12.5 and 50 multiplied by 13 will be the value of closing stock. This 100 bifurcation, 100 units multiplied by rupee 12.5 and 100 units multiplied by rupee 13 and 50 units multiplied by rupee 13. So 50 multiplied by 12.5, 625. This is 625. And 50 multiplied by 13 is 650. If we accumulate 625 and 650, 650 plus 625 equals 1275. So this is the value of closing stock. You can write over here value of closing stock equals rupee 1275. I believe it is clear. I believe it is clear. Let us see one more example of FIFO. One more example of FIFO. One more example of FIFO. Okay. So supposingly we have purchased 100 units at the rate of rupee 12. Again there is a purchase of say 200 units at rupee 13. So 100 plus 200 is 500. Again there is a purchase of 300 units at rupee 15. From this we have issued 400 units. We have issued 400 units at the rate 18. Calculate the value of closing stock. Calculate the value of closing stock or closing inventory. So over here 100 plus 200 plus 300 is 600 minus 400. So closing inventory is 200 and that is to be valued at latest figure. So this is at 15. Just write over here closing stock equals 100 plus 200 plus 300, 100 plus 200 plus 300 minus 400 equals 200 units, and value of closing stock equals 200 units multiplied by rupee 15. This is rupee 3000. I believe it is clear. I believe this example is clear. Have you all understood it well? Let us move to the next example. One more example of FIFO. First in, first out. Just write purchased 100 units at rupee 16. Then again we have purchased 150 units at the rate rupee 17. Then we have issued 125 units out of it. Issued 125 units at rupee say 20. Again we have purchased 100 units at rupee 18. Out of it we issued 75 units at rupee 21. At rupee 21 we have issued. Calculate the value of calculate the value of closing stock. Calculate the value of closing inventory. First, over here, we should find what is the closing inventory, the actual closing inventory. The actual closing inventory. So we have purchased 100 units plus 150 units. So 100 plus 150 equals 250. 250 plus 100 we have purchased 350. So purchased units is 350 units. From purchases we have issued 125 units over here and 75 units over here. So 125 units plus 75 units equals 200 units. So 350 units minus 200 units is 150 units. So 150 units is the closing inventory. We need to find out which 150 unit is this. So this is 100 units plus 150 units. Total we have issued 125. So 100 this should be issued and 25 is issued from here. 25 is issued from here. This is 150. So 100 is done. This 150 we have issued 25. So the remaining is 125 over here. The remaining is 125. Then we have purchased 100 units and issued 75. This 75 should be issued from this 125. So minus 25. The remaining is 50 now. 50 units is remaining at 17 rupees. Just write over here 50 units of 17 rupees, and the remaining 100 units is of 18 rupees over here. This is remaining. So 18 rupees, 100 into 18 is 1800. 50 multiplied by 17 is, please calculate 50 multiplied by 17, 850. So 850 plus 1800 equals 2650. 2650, value of closing inventory. Value of closing inventory equals 6250. I believe you must have understood till here. Okay. So what we have learnt in today's class, let's see a quick recap what we have learnt in today's class. So we tried to understand, we understood that how to value raw material and supplies. We seen the two cases. After that, we seen the various examples. We learned the treatment of normal loss and the treatment of abnormal loss, both the treatments which we have learned. We seen several examples in relation to this. Then we learnt about the inventory record system. The first system is periodic inventory system and the second is perpetual inventory system. We tried to understand the difference between periodic inventory system and perpetual inventory system. We also understood what are the limitations of periodic inventory system, what are the limitations of perpetual inventory system, which inventory system is beneficial for the or more beneficial for the company, whether it is periodic inventory system or perpetual inventory system. One thing we understood that the both the inventory system is beneficial for the company or the organization, but perpetual inventory system will give more accurate information. The periodic inventory system is basically the physical stock taking method. Over there, if we are taking the physical stock takings, we need to stop the work while taking the physical stock takings or physical stock audit, and at that point of time, no inflow and outflow of goods could happen. Secondly, one more thing is there in the periodic inventory system, that if there is any pilferage, theft, or any loss, that could not be found out, and the business organization should not be able to understand that if there any theft or loss has happened, because in periodic system we only calculate the closing stock value, and then how we calculate the cost of sales, purchases which is already known, opening inventory which is already known, closing inventory we have calculated, and then we find out what, the cost of goods sold, and then we find out the closing inventory. Basically, if we make a combination of these two systems, that is the perpetual inventory system and periodic inventory system, that would be in a, the company would be in a much better position. You can read over here, this system determines inventory and takes cost of goods sold as a residual figure. So we find the value of inventory, but we never know that if from this inventory whether the loss has happened, the theft has happened, or anything. But over here in perpetual inventory system, we find out cost of goods sold and then we calculate the value of inventory. I believe you understood. We shifted to this method known as, to determine the cost of inventory, we done two methods today. We have started with the specific identification method. Specific identification method. We done this example, and then after that we shifted to FIFO, that is first in first out method. We done this example, the solved example over here, and various cases in relation to FIFO, that how the goods should be valued, how the closing inventory should be valued in terms of FIFO, we have learned in this chapter. We have seen these many examples. I believe every example is clear to you. And at last, finally, we completed over here. We need to do few more illustrations, which is on FIFO. We'll be able to continue that, but we'll be doing in the next class. I believe all of you understood this. Thank you, students. Thank you very much.